Every business has secrets hidden in its budgets. Welcome to Flexible Budgets, Variances, and Management Control. Today we are going to follow a store manager detective as we learn standard costing, variance analysis, and how managers control costs one clue at a time. First, we'll establish standard costing foundations so you know how benchmarks are set. Next, we'll contrast static and flexible budgets to see how volume shifts affect costs. Then we'll uncover direct cost variances for materials and labor. Finally, we'll break down overhead variances for total control. Standard costing and variance concepts. Think of standards as our benchmarks for materials, labor, and overhead. The moment we compare actual results to these benchmarks, variances appear, our first clues. Tracking these favorable and unfavorable variances helps us pinpoint where costs diverged from expectations. A standard costing system defines benchmark prices, costs or quantities for materials, labor, and overhead. Actual results are compared against these standards to calculate variances, differences that are either favorable, improving income, or unfavorable, reducing income. Management by exception means focusing on significant variances that demand investigation. Now we move to static and flexible budgets, our next stage. A static budget locks in figures based on planned output, while a flexible budget adapts to actual volume. This flexibility helps managers separate volume-driven differences from genuine performance issues. Our next clue in variance analysis. Static budgets set planned figures at the start and don't adjust for actual volume, so differences become total variance. Flexible budgets adjust revenues and costs for actual output, using the same budgeted unit price, unit variable cost, and fixed costs. They reveal what should have happened. Level 1. Actual versus static budget. You're comparing actual results against the static, master, budget. The one set at the beginning of the period based on planned output, 12,000 units for web. This gives you the total static budget variance, $93,100. It's a crude first cut because it mixes volume effects with price/efficiency effects. The static budget doesn't adjust for anything. Level 2. Actual versus flexible budget, and flexible budget versus static budget. Now you introduce the flexible budget as a middle column. A flexible budget recalculates budgeted revenues and costs using the actual output achieved during the period, but keeps everything else at the original budgeted rates. Same budgeted selling price per unit, same budgeted variable cost per unit, same total fixed costs. Two comparisons happen. The flexible budget variance compares actual results to the flexible budget. Both are based on the same actual output, 10,000 units, so volume is held constant. Any difference here is purely from actual prices or efficiency deviating from budgeted rates. This is $29,100 for web. The sales volume variance compares the flexible budget to the static budget. Both use the same budgeted prices and costs per unit. The only thing that differs is volume, 10,000 actual versus 12,000 planned. This isolates the pure volume effect, $64,000 U means unfavorable, reduce income, and F means favorable, increase income. Sales, volume variance isolates effects of output differences. It arises when actual volume deviates from budgeted levels, holding price and costs constant. Common causes include failure to execute sales plans, weaker demand, aggressive competition, market shifts, and quality problems. Understanding these helps managers correct course early. Now we enter Section 3. Direct cost variances for materials and labor. These Level 3 variances break down into price and efficiency components. We'll examine how buying materials at different prices and using labor time effectively uncovers clues to improve cost performance on the shop floor. Price variance equals actual price, budgeted price, times actual quantity of input, showing whether we paid more or less per unit. Efficiency variance equals actual quantity used, budgeted quantity allowed, times budgeted price, showing if we used more or fewer inputs than allowed. Three-column decomposition starts with actual quantity times actual price to show total spend, then actual quantity times budgeted price to isolate price variance, and finally budgeted quantity allowed times budgeted price for the flexible budget amount. The differences between these three columns reveal the price variance, efficiency variance, and overall flexible budget variance. Here's a Hansen Incorporated example for Zippies. With a standard of 1.5 pounds at $4.00 per unit, actual purchases were 1,700 pounds costing $6.630 for 1,000 units. That gives an actual price of $3.90 and a standard quantity of 1,500 pounds. The price variance is $170 favorable, and the efficiency variance is $800 unfavorable. Web companies' Level 3 variances compare actual to standard for both materials and labor. Materials use 2,200 units at $28 instead of $30, creating a $44,400 favorable price variance and a $66,000 unfavorable efficiency variance. Labor hours of 9,000 at $22 versus $20 yield and $18,000 unfavorable price and a $20,000 unfavorable efficiency variance. Price variance is based on the full purchase quantity and recognized at purchase. Efficiency variance is based only on quantity used. If purchases exceed usage, price variance changes but efficiency variance stays the same. For example, 2,800 pounds at $3.90 versus $4.00 yields a $280 favorable price variance and a $800 unfavorable efficiency variance. Section 4. Overhead variances, both variable and fixed. Now our store manager digs into the overhead clues. We'll split overhead into spending and efficiency variances for variable costs, and spending and production volume variances for fixed costs. These markers will reveal capacity clues next. Get ready to analyze overhead like a detective. First, our detective breaks down variable overhead into two clues. The spending variance, actual VOH rate, budgeted VOH rate, times actual hours yields a $4.500 favorable signal when web paid less than planned. The efficiency variance, actual hours budgeted hours, times budgeted rate, flags $15,000 unfavorable as clues. Next, our detective examines fixed overhead variances. The spending variance, actual FOH minus budgeted FOH, gives an important $9,000 unfavorable clue since fixed costs didn't flex. Then the production volume variance, budgeted FOH minus FOH allocated, reveals exactly a $46,000 unfavorable signal, showing underused capacity lurking behind the numbers. Here's the important variance framework for overhead. Spending, efficiency, and production volume variances. Variable overhead flexes spending and efficiency, but never production volume. Fixed overhead flexes spending and production volume but never efficiency. Memorize the key never cells. They're your ultimate cheat code for exam success and real-world cost detective work. Our detective uncovers the complete variance hierarchy for web company. The $93.100 unfavorable static budget variance splits into a $29.100 unfavorable flex budget variance and a $64.000 unfavorable sales volume variance. Flex budget breaks further into price and efficiency clues across materials, labor, and overhead, revealing exactly where each cost control clue lies. To wrap up, variance analysis drills from total performance gaps to detailed price and efficiency clues. Flexible budgets give your should-have benchmark. Price variances track cost control, efficiency variances track usage control. For overhead, variable has spending and efficiency, fixed has spending and production volume. Always investigate root causes.